everyone, this is Vaishali Siddhappa and welcome to my channel Complemental Economics. And today's class it's about classification of receipts. The questions comes like explain the classification of receipts. It's one of the 6-mark question. What is actually receipts is all about? The budget receipts refers to the estimated receipts of the government from all sources during in a fiscal year. So the budget receipts can be classified again in two different ways, that is capital receipt and the revenue receipts. So to make it easy, what we'll do is first we'll analyze the revenue receipts, then we'll come back to capital receipts. So have a look. The first topic which I am going to discuss, that is revenue receipts. Now you can see a chart. Through this chart we are going to analyze the revenue receipts. What is revenue receipts is all about? The revenue receipts are those receipts that do not lead to a claim on the government. They are therefore termed as non-redeemable. They are also divided into two different ways. The two different ways which is divided, that is tax revenue and the non-tax revenue. Let's talk about tax revenue first. The tax is nothing but the money what people are going to pay to government as a taxes or duties. So from that if they are going to get the revenue, that's called tax revenue. The tax revenue can be classified into two different ways again, that is direct tax and the indirect tax. What is the difference between the direct tax and the indirect tax? Direct tax, the tax which is imposed on particular person. A burden will be on one particular person, he cannot transfer to any other person. The burden what he is on what he is having on his head, he should pay it. So that's called direct tax. On the other side, indirect tax, it is transferable from one person to one person. So if you do not purchase any of the goods, so the tax will be transferred. So this way, when it comes to direct tax, we have few of the taxes. The first, most importantly, the tax higher the tax what we are going to get, that is income tax. The income tax is levied on individual person. How much ever income I am going to earn, on the basis of that I have to pay taxes. If my income is more, the percentage of taxation it will be more. If my income is less, the taxation will be less. This kind of a taxing system what we have, the income tax system what we have in our country, that is called progressive tax system. Why we have this? Because we want to distribute money wealth equally in the country. So people who are having higher income, let them pay higher the tax. The people who are having lesser the income, they should pay the lesser the taxes. So this way. On the other side you have corporate tax. The corporate tax is that tax which is paid by the company for their ownership. So in the companies they have proportional basis taxes. How much profit they are getting, on the basis of that they are going to pay the taxes. Next we have a tax like wealth tax, gift tax, estate duty, expenditure tax. These all taxes, the revenue what we are going to get from these all taxes, that is really very less. For that reason we even call it as paper tax. The wealth tax, gift tax, estate duty, expenditure tax, the taxes what we are going to get, that is really very less. So the revenue to the government what we are going to get, that will be less. For that reason it is called as a paper tax. Recently the wealth tax is also abolished from the taxation. On the other side you have indirect taxes. Whenever you purchase any of the goods and services, so for that you have to pay tax, that's called indirect tax. So whatever the goods you're purchasing, for that if you're paying a tax, that's called as a GST. Recently GST got introduced, that means couple of years before the GST got introduced. GST is nothing but goods and services tax. The goods and services tax what we have, the tax will be imposed on each good on the basis of what is the necessary of that. Any good which is really very necessary, without that you cannot survive, on those kind of a goods tax will be very less. Lower the taxes. Sometimes you do not have tax only for these kind of necessaries, otherwise even though we are imposing the tax, that will be very less. On the other side, if the goods are comforts, The comfort goods are mediumly taxed. And the last one, if the good is luxurious, semi-luxurious or luxurious goods, for that the taxation will be very higher. For an example, tobacco, petroleum, these kind of goods whatever we are purchasing, so that is the all goods are taxed very heavily. So this way the goods and services tax also we have on the basis of whether the good is necessary, luxury, yeah, comfort. On the other side, after the tax revenue, we have non-tax revenue. When it comes to non-tax revenue, the first of all, interest receipts. The central government, if they have given any loans to anyone, so the interest what they are collecting, that also comes under non-tax revenue. From tax they are not going to get, other than the tax whatever the revenue they are going to get, that comes under non-tax revenue. And the next one, profits and the dividends. Profit and dividend is nothing but if the government is owning any kind of companies, yeah, PSU, anything, from there whatever the income they are going to get, that comes under profits and dividend. Fees and fines. The fees and fines, the central government, they are going to impose some fines and fees to the officers, yeah, some other things. So on that, if they are going to get any kind of a fees and fines, that's also part of non-tax revenue. External grants. So that means whenever we feel like we are going through with some of the problems, some other countries, yeah, some other international organization, they always give some kind of a help to us, so that money we no need to give back. That's called as an external grant. We are getting any money, any help from any kind of a aid, cash grants in aid from any foreign countries, yeah, any international organization, that also included in the external grants. So special assessment, so these all the part of non-tax revenues. After that, let's talk about another part of it, that is capital receipt. When it comes to capital receipt, it refers to those receipts which either create the liability or cause a reduction in the re-asset of the re-government. So in this case, capital receipts are classified into two different ways. Debt creating capital receipts. When it comes to debt create capital receipts, that means it's completely a loan. So the loan you can borrow from internal and the external. From the internal, that means you're going to take loans from few of the, for an example, you're going to borrow money from any other people who are in the country. Otherwise, from the external debt. The external debt you can get it from the World Bank, International Monetary Fund. So anywhere if you're going to take loans, that will be called as external debt. Internal, from within the country you're going to borrow money. External debt, that means after the, from other countries you're going to borrow money. On the next side, non-debt creating capital receipts. In this one, the first one, recoveries of loans and advances. Government grants various loans to the state governments or union territories. Recoveries of such loans is a capital receipt, as it reduces the assets of the government. And one more here we have to add when it comes to non-debt creating capital receipts, that is the third one, disinvestment. What is disinvestment? It refers to the act of selling a part of whole of shares of a selected public sector undertakings, which called as a PSU. Held by the government, they are termed as a capital receipts, as they reduce the assets of the government. The government holds ownership in PSU in the form of equity shares. When government sells a part of or whole of its shares, it leads to transfer of ownership of PSUs to the private enterprise. So like this, if you're going to sell your equity share, government any equity share, we're going to lose our asset. And the next one you have, that is after the disinvestment, you have small savings. The last one is small saving. When it comes to small saving, it refers to funds raised by the public in the form of post office deposit, national saving certificates, Kisan Vikas Patras. So they are treated as capital receipts, as they lead to an increasing liability in the economy. So these are the part of capital receipts. Debt creating capital receipts, internal and external. Non-debt creating capital receipt, which is recovery, loans and advances, disinvestment and the small savings. This is a complete chart of a budget receipts, revenue receipts and the capital receipts. So both you can see revenue receipts, you have tax and in tax and non-tax revenue on the capital receipts. Thank you so much. If you really understood my videos, please subscribe and share. Thank you so much.